we've got Rupal Agarwal now joining in, Senior Research Analyst, Asia Quantitative Strategy at Bernstein. Rupal, thank you very much. Great to have you with us back on the program. So how are things looking, Rupal, now, according to you and the team at Bernstein? Because there is significant lead lag, right? I mean, the market here in India has rallied on irrespective of whether global markets have been up or down. In the US last week, we saw a bit of turn higher after 3 weeks of falls. No problems here in India for many weeks now. We were up another 1.5% of the benchmark index. Your thoughts from here?
Yeah, I mean, Prashant, we still remain a little bit more cautious. I think the macro risk still persists, and I sort of agree. You know, the Indian market have been relatively much more resilient. And there have been some external factors to it, along with, of course, the domestic story being strong. But I think that the China, not doing well, and a lot of investors not being comfortable, adding more China exposure has, in some sense, helped this reversal that we've seen in FIs coming back. So I think there have been some external factors. From here on, we are still, remaining more cautious, I would say. There are, of course, signs of some breather coming to the market in the form of if, inflation starts coming down significantly. But I think there's still some time, for that to happen. And hence, in the shorter term, we still remain more cautious than being more risk-off.
Okay. Rupal, good morning. So, the jury is still out on the US market, right? I mean, India has outperformed and very close to its 52-week highs. But is there a probability, whatever small or high, that the US market makes a visit back towards its recent lows? And in that case, would the Indian market also have to take cognizance of that, or can the outperformance still continue?
I mean, again, I think on the US side, see the way that the markets have behaved till now, it seems like there's a lot more reaction in line with how markets have typically reacted post GFC. So they've sort of reacted in a way that they would have in a QE world, which we are not yet in, right? We are in a QT world. We are in for or we are seeing Fed hiking cycle, and it's not really accommodative. So I think from that standpoint, given that inflation still remains very high, Fed's resolve to bring down inflation remains very high. To me, it looks unlikely that markets are going to rally very strongly. Having said that, if you look at any of the previous bear markets, we've actually seen some of the sharpest and the strongest and the longest bear market rallies. If whenever we've seen the bear markets being very long or more persistent, so we could potentially see both ways volatility increasing. And that's what we expect in US. So I think it's going to be, or markets will remain, quite volatile. And there will be days like today, where we have everything in the green. Again, if you look at what's been driving that, it's broadly, positive macro sentiment, which, given we are expecting, inflation numbers coming next week, we could potentially start seeing that reversal. So, as I said, we are still remaining more cautious than very bullish in the shorter term because the macro risks are still out there.
Okay, you're also cautious on India, you said, right?
Sorry?
Did you also say that you're cautious even on the Indian markets?
We are, yes.
Okay.
Because if you look at how India has moved, yes, India has been very resilient, but broadly the trends have been very similar to US markets. This entire rally that we've seen since June has been completely in line with US.
Okay.
There have been reversal of FIs, but domestics now are becoming less bullish. That could change the sentiment when it comes to India. Valuations again look unsustainable to us, given there is still risk to earnings, there's still risk to margins. So I think and the fact that in India yields are moving higher, and Fed along with Fed, RBI will have to sort of align their own policy, which means that we are looking for a much higher yields, and historically that's again not been great for markets. So I would say that we really tried to find catalysts in the short term for us to become more constructive. Unfortunately, we couldn't find many. So I think that's again the reason why even in India, we are remaining more cautious.
Sure. The reason I asked you is because there are many macros that are turning favorable in India as well, right? I mean, we were looking at the data. Corporate profit to GDP, the ratio is now what? At a decadal high in this year at about 4.3%. And generally, bull markets are based on improvement in corporate profitability. Apart from that as well, I mean, if you look at it, Brent crude prices are down. CPI has fallen for 4-5 straight months. The PMI data has improved. So compared to a global context, don't you think that India could see outsized flows from FIIs even from here on?
So, domestically, I agree. Indian data is looking much better. And, that's been one of the reasons we've started seeing FIs coming back. But as I mentioned earlier, a lot of that has also to do with the fact that other economies are looking much worse. So, yes, we could continue to see some, flow back into India. But again, a lot of that will have to depend on how dollar moves, how yields move in US, because, if it's a larger capital outflow from EM kind of a trade, then India will also face the brunt of it. So I think that's one point. The other thing is that if we look in terms of how India has been moving with US markets, there has been a significantly higher co-movement between India and US equity. And I would say not just India, I mean, in broadly, Asian markets. So until and unless we start becoming quite constructive on US equities, on a standalone basis, it becomes difficult to make an overweight call on India. But relative to some of the other markets, given that India is, of course, the only region where we are still seeing much stronger growth, though, the growth even in India is slowing. That's been one of the reasons why investors have been, more attracted to India in the short term. But we are still remaining more cautious. We still need to see more signs of a broad-based recovery before we start becoming more constructive.
Purely, Rupal, based on your sort of quant models and data, which areas look attractive to you, even now in the Indian context?
So if I look from a sector perspective, I think the last time we spoke, we are pretty much, maintaining a very similar view of this balanced approach of having, more of a barbell portfolio, where on one side we have, your defensive pockets, we have IT, a fair bit of staples, but on the other side, we do have inflation hedges like energy, materials. So it's more of a, I would say, more of a balanced and barbell approach than being very overweight or underweight on certain sectors. When it comes to financials, again, we are focused more on or we are recommending more, more bigger banks, which are, relatively less cyclical, but of course not getting into any sectors or stocks which are, quite overvalued. So I think valuation still remains a key criteria to sort of navigate this uncertainty.
Rupal, I know you did touch upon this, but is there a risk that the equity market is perhaps just ignoring the risks? The quantitative tightening pace doubling, the bond market being in a first bear market in decades for first time since 1980. Could this really hurt come October or November? We've seen this in the past, how sometimes the markets ignore cues from money markets, equity markets that is, and the catch-up is rather fast.
I mean, quite likely. In fact, that's broadly the sense that, or the reason why we still remain more cautious. And, the point that I made earlier, markets will always see this very strong bear market rallies or in between rallies before we start seeing, another leg down. So I do think that, there could be another downside which could, beat the previous lows because of, a risk of a recession still out there, the risk of a very aggressive Fed, which again, means yields moving higher, dollar is still quite high. So a lot of these macro risks, I think, are still there, which I do think that markets are not completely pricing in, including, earnings, which have till now been relatively more resilient, but we started seeing an earnings downgrade cycle. And we do think that we are just at the beginning of one. and hence that could also be one of the key drivers for this next leg down that we could potentially see in the markets.